Welcome back to Dad Ruins Everything. Last time, I ruined astrology. Today, I ruin extended warranties. A warranty is a guarantee provided by a manufacturer or seller that a product will perform as promised for the warranty's term. If a product fails due to defects in materials or workmanship within that time, the product will normally be repaired, replaced, or refunded at little or no cost to the buyer. A warranty is generally offered with a product to give a buyer the peace of mind that they're not bearing all of the financial risk if the product fails to perform as expected within the warranty's term. Warranties typically have limits on what consists of normal use, as well as limits on what the manufacturer or seller will repair or replace. In the case of a car, for example, parts that are subject to normal wear, like tires, belts, or brake pads, are not covered. Most people don't give much thought to warranties, but they are essentially financial bets that are based on a mathematical model. When offering a warranty, the costs of repair, replacement, and service must be estimated, including labor, parts, logistics, and customer service expenses. Then, the company must set aside a portion of their revenue as warranty reserve to cover the cost of claims. This is usually baked into the price of the item, so the implications of warranty cost and accuracy are either higher than expected losses or unnecessarily high product pricing. So that's regular warranties. What about extended warranties? Extended warranties can be offered by the seller or manufacturer, or they may be sold by third parties. Usually, extended warranties offer coverage when the original warranty expires. They may also have greater scope than the original warranty as far as the conditions that are covered. In general, the reason why extended warranties are usually a bad idea is that, like regular warranties, extended warranties are based on a mathematical model. The main difference is that extended warranties always have profit as a component of the offering price. That's really always going to be an issue when the product is the warranty. Assuming that you are not above the mean failure costs by more than the warranty price, they are making money off of you. And this makes sense because an extended warranty is like a small insurance policy for the one item in question. Just like insurance, though, the expectation is that the insurer will make money in the aggregate based on the accuracy of their actuarial risk calculations. It shouldn't surprise you to learn that companies make large profits on extended warranties because the claims cost much less than the premiums. One common way to manage this is making sure that the extended warranty period is shorter than the time in which the product is likely to fail. If something does fail, the warranty typically costs more than the average costs of repair. To limit the size of the claim that may need to be paid, extended warranties typically have exclusions for accidental damage, wear and tear, and limitations on what parts are covered. There may even be a per incident or per policy deductible. If that wasn't bad enough, the claims process can be extremely difficult, depending on who is offering the warranty. Repair or replacement may take a long time, and repair may require you to send the item to a repair center or depot, possibly at your cost, both ways. Even with all of that, an extended warranty can sometimes work out in your favor. That can happen for a couple reasons. One reason would be that the warranty cost estimates are underestimated. This can result in the warranty being priced lower than it should be. Another reason that an extended warranty may be okay is that you experience worse than average reliability. Yay? A good example of both of these was a Doug DeMuro series on CarMax's bumper-to-bumper extended warranty with a used Range Rover. He kept track of his warranty service costs versus the price of his extended warranty. It was a perfect example of the warranty underwriter not having a grasp of exactly how unreliable an old Range Rover is, or how expensive the vehicle repairs are. Yes, the warranty worked out in Doug's favor, but he was also without his vehicle frequently, and for weeks at a time. At least his vehicle repair costs were covered, and it ultimately worked out for him because his primary motivation was to create content for YouTube. You, on the other hand, may not find frequent failures of a critical device to be humorous. Another positive example of warranties would be my Asurion warranties on top-load water coolers I get for the house and business. Asurion warranties are add-on options for several items sold on Amazon, though you may know of them from their device protection plans with major wireless carriers. While I would normally not opt for this kind of warranty, I had the experience of 5 of 5 water coolers failing within 30 months of purchase. The failures would be at the pump, or the compressor, or both. Not anticipating that these component failures would get any better with newer units, I started getting extended warranties on the new units after my third failure. I've gotten $750 worth of water coolers for $120 of extended warranty costs. The warranties don't make the coolers any more reliable, but it does control my replacement cost, and I'm only confident in buying the warranties because I know that the failure rate isn't properly accounted for in the warranty term and pricing. In these instances, the warranties were only worth the price for Doug and I because the warranty companies incorrectly modeled the failure rates and repair costs for the items that they cover. Unless you specifically know this to be the case with the extended warranty and the item it covers, you're better off saving your money and using it towards possible future repairs. This is pretty universal advice, even covering extended car warranties and extended warranties offered directly from a product's manufacturer. Speaking of extended car warranties, I have a special message specifically about them. If you buy an extended warranty when you're buying a car, the cost of the extended warranty will be financed. Typically, those warranties don't start coverage until your existing manufacturer's warranty is run out. That means that you're paying for the warranty and the interest on it before it's even in effect. If your loan term is longer than your warranty coverage, you're paying on the warranty and the interest on it when you're no longer covered. If you haven't picked it up from my subtle communication cues, I think extended car warranties are an especially bad idea for a lot of reasons. You can ask me about them in the comments if you want to know more. I've talked with many people that have positive stories about extended warranties, and chances are that you have heard good things about them as well. Logically speaking, though, you must understand that these are the statistical outliers. If the anecdotes were representative of the experiences of everyone getting extended warranties, they would no longer exist because the companies offering these warranties would be out of business. Unless you are an unusually unlucky person, you should just put aside any money that you would have used to buy an extended warranty into an account that you don't generally use. In the case of something like an extended warranty on a car, you should keep in mind that the warranty cost will often be rolled into the loan amount. So a $3,000 extended warranty put into a 6-year 10% car note will cost you $3,800. Statistically, you should be better off putting a $52 monthly accrual into a repair savings account instead. If your car is more reliable than expected, you will come out far ahead. The newest wrinkle I've seen with consumer warranties is the concept of an extended warranty subscription. These are hybrid products that are more like medical insurance for your devices. Device coverage depends on the plan that you get, as does the coverage type. Similarly, there is often a copay depending on the type of service required. Other services are often bundled to improve the apparent value of the complete product. The bottom line is that you have coverage while you continue your subscription, so the idea is that you will stay on the subscription forever. Whether this is a good financial decision is still a matter of chance. The best thing to do is to come up with what you think your claim activity will really look like in a year. In the case of Asurion Home Plus, it would be $420 plus your service fees every year. If you currently pay for cloud storage, you may be able to remove that from your monthly or annual expenses. Maybe the math will work out in your favor. However, considering that Asurion has over 16,000 employees and a revenue of over $3 billion a year, I think it's safe to say that the math is almost always working out in their favor. And really, that's going to be the case for any warranty provider that manages to stay in business for any amount of time at all. And with that, I hope extended warranties are sufficiently ruined for you, or for someone you're going to forward this to. I have ideas about what I'd like to ruin in the future, but I'd also appreciate suggestions from all of you. If you found this video to be educational or entertaining and would like to see more like it, please like this video and subscribe to my channel. I'm just getting this thing started and I could really use your help. Feel free to suggest, argue, or whatever in the comments below. Thanks, and have an awesome day.